G'day there. So you're getting close to that big 60, and you've got a self-managed super fund. Well, you're in exactly the right place. We're going to break down everything you need to know about getting your hands on that money you've worked so hard to save up. No confusing jargon, just a straight-up guide. Let's get into it.
Look, turning 60 isn't just about another cake and candles, is it? It is a huge deal for your finances. Honestly, this is the age where the whole super game really starts to tip in your favor. Think of all that money you've built up over the decades. Well, the vault door is starting to creak open, and we're about to show you how to unlock it.
All right, first things first, we've got to talk about something called your preservation age. Now, what on earth is that? Well, you can think of it as the government's official green light. It's the absolute earliest you're allowed to touch your super. And for pretty much everyone these days, that magic number is 60. And you know what? It's actually really simple. If your birthday is after the 30th of June, 1964, then your preservation age is 60. Done. It used to be this whole sliding scale thing, which was a bit confusing, but now for almost anyone thinking about retirement, 60 is the number. So hey, that's the first hurdle out of the way. Easy. But, and this is important, hitting 60 is only the first part of the equation. It's like you've got a lock that needs two keys to open it. Reaching your preservation age, that's key number one. The second key you need is something called a condition of release. So, what does that actually mean? Let's take a look. Okay, so to get that second key to work, you just need to tick one of these boxes. The most obvious one, of course, is just retiring for good. But look closely at that second one. Cease an employment arrangement. This is where it gets really interesting and flexible. It means you could just leave one job after you turn 60 and bam, you've met the condition, you've got access. Then there's turning 65, which is kind of an automatic pass, doesn't matter if you're still working. And that last one, a special kind of pension. We'll get to that in just a minute. Now, I really want to double down on this point because it's so important. Once you're over 60, the word retirement gets a whole new meaning. It doesn't mean you have to pack it all in and go play golf forever, unless you want to, of course. It just means you stop one job. That's it. What you plan to do next, start a new job, a business, travel the world, is completely irrelevant. This gives you a massive amount of freedom to design what comes next.
Okay, let's get to the best part. I mean, the single biggest, most powerful reason that turning 60 is such a big deal for your super. This is the absolute game changer. It's the reason your accountant might actually crack a smile when you mention this birthday. It all comes down to one thing, tax. Or to be more precise, the complete lack of it.
Yep, that's the number. 0%. Zilch. Nada. That is the tax rate on money you take out of your super fund once you're 60. As long as it's a standard taxed fund, which nearly all SMSFs are, that's your tax rate. It's an absolutely incredible number when it comes to planning your finances. So let's just make sure that's crystal clear. We're talking about any withdrawals. So if you set up a pension to pay yourself a regular income, tax-free, if you decide to take out a big chunk of cash, a lump sum, to pay off the house or buy that caravan you've been dreaming of, completely tax-free. This is your reward, really, for locking that money away for decades. It's easily the biggest financial win of turning 60. Right, so let's recap. You're 60, you've met one of those conditions of release, you know the money's coming out tax-free. Awesome. So what's next? Well, now you've got a pretty big decision to make. How do you actually want to take the money out? You've basically got two main options. Start a regular pension or take out a one-off lump sum. Let's look at the pros and cons of each. So here's the deal. With a pension, you get that steady, regular income, kind of like a paycheck in retirement. And the really big plus is that the big chunk of money that's funding your pension stays inside the super system, where its investment earnings are, you guessed it, tax-free. With a lump sum, you get all the cash up front, total freedom. But as soon as that money hits your bank account, any interest or earnings it makes from then on is taxed at your normal rate. So yeah, it's a classic trade-off. Ongoing tax perks versus having all the cash right now. Now, if you're leaning towards the pension idea, there are two main flavors you'll come across in an SMSF. First, there's what's called a simple account-based pension. Just think of this as your standard issue retirement pension. You've stopped working, and this is what pays you every fortnight or month. The other one is called a transition to retirement pension, or TTR. And this one's a really clever strategy if you're not quite ready to stop working completely. So, a TTR is for people who've hit 60 but are still on the job. It lets you tap into your super a little bit, drawing out up to 10% of your balance each year. Now, why would you do this? Well, two big reasons. One, maybe you want to cut back from 5 days a week to 3, and you use the pension to top up your pay packet. Simple. But the second reason is a really neat little trick. You can ramp up your salary sacrifice, putting more of your pre-tax pay into your super, and then use the tax-free pension payments from the TTR to live on. You end up with the same cash in hand, but you've paid way less income tax and given your super a massive last-minute boost. It's a super popular strategy, and you can see why. All right, so that's all the theory. It's great to know what's possible, but how do you actually make it happen? Let's get practical and run through the actual steps you need to take to get your SMSF ready to start paying you. This is where the rubber hits the road.
First up, you have to check your SMSF's trust deed. That's basically the constitution for your fund, its rulebook. You've got to make sure it actually allows for pensions and lump sums. Step 2, have a good hard think about your finances. How much do you actually need to live on? Get a budget together. Third, you need to formally document everything. Tell your fund, which is, well, you, that you're starting to take benefits. It has to be all official. But honestly, the most important step, and with an SMSF this is absolutely non-negotiable, is to get professional advice. Talk to an SMSF specialist or a financial advisor. They'll make sure you're doing everything by the book and that your plan is the right one for you.
Now, there's one more big rule you need to know about, and it's called the transfer balance cap. Basically, there's a limit on how much money you can move into that completely tax-free pension account. Right now, it's sitting at $1.9 million. So if you're lucky enough to have more than that in your super, anything over the cap has to stay in what's called your accumulation account. The earnings in there are still taxed at a pretty good rate of 15%, but it's not the 0% you get on the pension money. It's a really important piece of the puzzle you have to plan for. So there you have it. Turning 60 really does throw open the doors to your super in a massive, and best of all, tax-free way. You've literally spent your entire working life building up this nest egg for this exact moment. The only question left is your strategy ready to make the most of it? Thanks for joining me.